The stock market is not the economy. There's no better time to talk about this because we're in the middle of a recession that's the worst we've seen since probably the Great Depression. And at the same time, the NASDAQ Composite's up over 14% on the year, and the S&P is down less than 1%. Let's call that flat. I'm going to talk about the three ways that we generally consider when determining how the stock market will do. The first is GDP, the second is inflation, and the third is the Fed balance sheet. First, this is not investment advice. I am an investment advisor, and if you're interested in talking to me to work together on your own personal portfolio, please reach out to me. My email address is in the description. GDP, I'd like to talk about first, not because it's the best, but it's because it's the one that we typically use, and even people, professionals in the investment business, typically use it also. The point here to take away is we have had periods where GDP has had very strong growth and the market has had lackluster gains. And we have had other periods where GDP has grown much more slowly and the stock market has had great returns. So what's going on here? Let's first look at an article that Warren Buffett wrote in Fortune in 2001. And in this article, he picks out two 17-year periods, right? 17 years, pretty decent chunk of time. Here's the first 17-year period. It starts in 1964 and goes to 1981. So if in the early 60s, you thought the economy was going to do very well in the medium term, and you decided to buy the Dow Jones, you would have been right about the economy and you wouldn't have made any money, okay? We see that the gain in gross national product, Warren Buffett highlights, was 373% over that time period. Pretty strong gains, but yet the stock market was roughly flat. Now let's look at the next 17-year period, starting in 1981. From 1981 until 1998, the national GDP was up 177%, so less than half of the growth from the previous period. But you see here, the Dow Jones had very strong growth over that period. So what is this all about? Well, Warren Buffett makes the important point that interest rates are critical to this, right? And we had high inflation in the 70s. Interest rates were going up and up and up, and they topped out in 1980 or 1981, and that set the stage for inflation and interest rates to have a long secular move down into a sweet spot for equity prices and equity multiples. So that's the first point I want to make here. You could have been right about predicting how the economy would do, and it would not have informed you as to whether to invest in the stock market or not. The next point I want to talk about is inflation. And so as I've read zillions of things over the decades, I put aside these great analysis when I see it sometimes. And this was one of those papers. It was 2009, and Russell Napier was at CLSA. And in this analysis, he looks at inflation rates and bond yields compared to the equity market. And what he found in this analysis is that inflation at 4%, inflation that starts to rise above 4%, is historically capped the equity market rally. Now, it probably does this because as inflation is going up above 4%, then the central bank, in this case the Federal Reserve, takes action to start raising interest rates, and that becomes a big headwind for equity prices. So, as Warren Buffett highlights interest rates, and Napier talks about inflation. Obviously, there's a relationship between interest rates and inflation. Higher inflation means that the central bank will raise interest rates, and that becomes a headwind to equity prices. He looks at a handful of episodes prior to 2009 to look at inflation and bond yields, and looks at bond yields moving somewhere between 5 to 6.5%, and inflation at 4%, above 4%, starts to cap that rally. So this was incredibly important to me. What this basically says is that if I could wave a wand and know the future and only know one metric, right? If I can only know one thing, it wouldn't be GDP. the thing that I would want to know before GDP, prior to the next point I'm going to talk about, the thing I would want to know is inflation. I would want to know where inflation was going to be, because essentially we have a sweet spot of somewhere between 1.5% and 3.5% inflation, low and stable inflation that gives equity prices a high multiple. Okay, so when inflation is low and stable, that is very good for equity prices. So if I could wave a wand and know one thing, it would be inflation. Okay, now that leads us to the third point. Things changed after 2009 when the Fed hit the zero lower bound and needed to start using its balance sheet as a tool to add accommodation. And we can look at a couple graphs and get an idea here. This is a longer term graph that shows the blue line is the Fed's balance sheet. And so you see the Fed during the Great Recession back in 2008, 2009, starting to add huge amount of securities to its balance sheet. And you can see the relationship between the equity market in red and the Fed's balance sheet. And to look more specifically here, this is the episode that we are currently in now. Okay, so look at the yellow line, which is the Fed's balance sheet, and the blue line, which is the S&P. David Rosenberg, great economist who recently launched his own firm, David Rosenberg Research, he highlights that the Fed has expanded its balance sheet more in 3 months by over 70% to $7 trillion than it did in the 6 years from December 2007 to 2013. And he also looks at, you remember that last picture I just showed you? There's a 90% correlation between the Fed's balance sheet and the S&P 500. Okay, one last quote that I'll mention about liquidity is Stan Druckenmiller. He was recently interviewed and he said, there's one comment that I've consistently repeated: liquidity moves markets much more than earnings do. I think he said something about in the short or the medium term. He doesn't say that valuations don't matter. So back to the GDP part, because Warren Buffett references GDP also. It's not that GDP doesn't matter, okay? It's that inflation matters a lot, and we've seen in the recent 10 years, the Federal Reserve balance sheet and liquidity matters a lot. So where are we now? The stock market is expensive. In this case, very expensive, since we don't really know where earnings will be. But we have dramatically expanding liquidity, and we also have inflation that, even if it's not in the sweet spot, I think will very likely be moving back towards the sweet spot. Okay, so when the liquidity profile changes and maybe inflation changes, then it might be important to make some big changes. You know, typically when we go into a recession, it takes the authorities a long time to act. Normally, we don't even know that we were in a recession until after it already happened, in terms of when the NBER determines when to date the recession. This was a very unusual case where we knew that we were headed straight into a recession when the government basically locked everything down. So the benefit to that is that the authorities also knew extremely quickly to put these programs in place. So even though bad things typically happen in a recession in the stock market, and that happened in this case, but also we recovered so quickly because of the Fed balance sheet liquidity. So the main takeaway is this: when someone is talking about the stock market and references the economy, that's fine. That is an important part of the picture. But also critical parts of the picture is what's happening with inflation and what's happening with liquidity, and how are changes in the economy likely to affect those two variables. That's all. Thanks for watching. Don't forget to subscribe.